Hey, what's up, Market Moose? Mike from the Moose on the Loose. Happy Monday. All right, so today we're going to talk about 10 IP ratio Canadian dividend paying stocks that I actually like. And a lot of people will tell me, but Mike, that doesn't make sense. Why would you buy a stock with a P ratio above 25? And some of them on that list are like above 50. That's kind of crazy. And yet they're great businesses. So we're going to take a look at it together, and we're going to see from the cheapest one to the most expensive one why they should deserve at least some attention in your portfolio. I'm not telling you to buy them, but maybe you want to take a look at it, do some due diligence, and realize that maybe there's something interesting on it. And there's a reason why investors are ready to pay so much for those stocks. So let's get started because we have 10 minutes. Jamieson Wellness, GWEL.TO, P ratio of 27. First, it's a small cap. It has a lot of growth vectors. If you look at the dividend triangle, the revenue is increasing very fast. They are selling vitamins and supplements, not only in Canada, but in the US and also internationally, especially in China. This is where they have lots of growth going on, and they spend a lot of money there to keep on growing. So, which explains that the earnings per share are not always following the revenue trend, but it also means that the investors are ready to pay a little premium on this one. Next one on the list, Loblaw, ticker L.TO, P ratio around 28. This one has been the best grocery store in Canada for a long while. They have a dominant presence. They consistently report great numbers, and there's a price to pay for quality. And this is why Loblaw trades at such a high P ratio. Next on the list, Telus, T.TO, kind of crazy, right? The P ratio is around 35. This case, probably not, because you have to pay for quality, because Telus has been struggling for a long while. What happened here is the earnings per share is not exactly a good metric to track for telcos, because they have lots of amortization and lots of capex that will affect earnings. And since the P ratio is based on earnings, well, this is also explaining why this metric sounds off. If you look at Telus, though, it is a very strong wireless provider. They do have some growth options with Telus Health, Telus Agriculture, and Telus International. I hope they will generate more cash flow in the future to convince investors that they are not another BCE. But still, we have to be careful about this one. The yield is high. And yes, they kept on increasing their dividend, but their debt is also increasing as well. Next one, TMX Group. I just added into my Smith maneuver in my $1,000 a month portfolio. TMX Group, I mean, great combination of revenue growth, earnings growth, and strong dividend growth. They have kind of like a monopoly on the stock exchange. Most of their revenue, about like 2/3 of their revenue, are recurring. So you have stability, you have growth opportunities on the stock market, and you have dominant presence. Well, therefore, there's a price to pay again. Another one on the list, Terravest Industries, TVK.TO, 37 times the earnings. Now we're going up a little. This one, it's a small cap, growth by acquisition, big time. So a lot of investors are excited by it. They operates into storage, tank, and natural gas maintenance. What I like about them is after they made a lot of acquisitions, now they're growing their maintenance services, which will increase their recurring revenue, because if not, they will depend on buying more competitors. It's a highly fragmented market. There's room for that. But again, small cap, IP, you have to tread with a little bit of cautious here, especially at 37 times the earnings. Next one on my list, Franco-Nevada at a P ratio of 45. Gold streamer, no debt. Gold is hot right now. That explains a lot. They had some problems with the Cobre mine in Panama, and the mine has not started yet, but it's kind of like priced that the investors are quite positive about this one. They also recently reported a record quarter, which of course helped for the hype. So Franco-Nevada, if you're looking for a player on gold with a company with no debt, and they're not like, they don't have to spend too much money into the operation because they own the land and then they get royalties instead, that could be an interesting business model to investigate. Another one that is super exciting, and I'm trying to build a full position on this one, so trying to put it to 3% of my portfolio, it's Dollarama. DOL.TO, trading at a P ratio of 44. So we're still in those rows. At first, when I made the list, it was slightly higher than Franco-Nevada, so that's why I have it on the list a little bit higher. But then a couple of days later, they reported their earnings. Market got a bit worried, and there you go. Now it's down a little bit more so on the stock price. And this is what sometimes happens with those companies. They are priced for perfection. If you look at Dollarama dividend triangle, you'll see steady revenue growth, steady earnings growth, steady dividend growth. It's kind of like crazy. Everything is double digit. They have a mix of organic and growth by acquisition on top of that. And then investors are just craving for this type of businesses. And that's why Dollarama is trading at such a high PE ratio. But on average, it's usually what happens with this one. It keeps a very high valuation all the time. Now, price for perfection means that if you're making a misstep, if you disappoint analysts with a bad quarter, and sometimes even the numbers are good, but it's just not enough for investors, well, then your stock price will drop. We saw that with National Bank not too long ago as well. The company was getting to its all-time high at around $150. Reported earnings disappointed, even though they were good, and then the stock price dropped like 5% in the 2 days after reporting the earnings. All right, so we have now the top 3 left on this list. Thomson Reuters, TRI, trading on both the US and Canadian side with a whooping P ratio of 49. So 49 times the earnings for Thomson Reuters. Another one that offers a lot of stability, a very long history of dividend growth, and a lot of recurring revenue. They are serving specialty services, so providing information and a true subscription to corporations, accounting firms, and law firms. And of course, as a law firm, if you depend on information to make your research, you're going to keep your subscription pretty much forever. So Thomson Reuters benefit from that sticky business model. They can increase the price of their subscription. So that's kind of interesting. But again, this one reported disappointing earnings not too long ago. The stock price fell and still trades at a high P ratio. So that shows you that when you're priced for perfection, it can go a long way. Now you have to consider the downside for Thomson Reuters. I see maybe lack of growth, maybe like mid-single digit going forward. So sometimes I'm not too sure why it's trading at such a high PE. But again, it's up to you to decide if it's a good fit for your portfolio or not. The next one, number 2 on the list, Waste Connection, WCN, usually trades between 50 to 70 times earnings. Again, crazy valuation. This one kind of like understandable in a sense, though. If you look at the average PE for the past 5 and 10 years, it's always looking super overpriced. But the thing is, they operate into kind of like monopolies. When they have a contract with a city to take care of like waste management, well, it's going to be them for a long, long time. And they have a very strong economic moat by having those large landfills. They're highly regulated. It's really hard to have them. So when you have a good portfolio of landfills, you can have a good network, and therefore you're just piling up the recurring revenue all the time. So not a super sexy business, but definitely working well. And the last but not the least, Brookfield Corporation, ticker BN, P ratio of 150 right now. This one is just crazy. It's crazy because you should not look at the P ratio at all. And it's hard because then you're having a hard time to determine which kind of metrics to use for valuation. And this comes as the highest risk for Brookfield. Super complex business. It's a holdings of so many different arms such as like credit, insurance, infrastructure, utilities, and so on. So Brookfield, they invest their own capital into projects. They also manage funds for others, for investing firms, for pension plans, for investors. So they have plenty of ways to make money, but the fact that they have a very complex financial structure, the earnings based on accounting rules are not suitable to analyze. So cannot really rely on EPS, cannot really rely on the PE ratio either. So the sweet spot is more to look at the funds from operation and then the FFO per share as a good way to analyze the stock trend and its profitability. So right, Moose, I hope that you have enjoyed this one. If you have any other high valuation companies that you would like to mention, you can go on YouTube because we have now the video for the Moose on the Loose and let your comment there. So we're going to talk again tomorrow. Until then, don't forget to stay invested.